Good evening, and welcome to Greenleaf Trust's 2022 Year in Review and 2023 Outlook Seminar. It's great to be back in person, and on behalf of the entire team at Greenleaf Trust, we want to thank you all for your continued partnership in what has amounted to a very challenging year for the investment markets. We have a great program for you tonight. For those of you who may not know me, I'm Nick Juhle, Greenleaf Trust's Chief Investment Officer. I'm joined on stage by my esteemed colleague, Vice President and Assistant Director of Research, Chris Burns. We are, of course, supported by our in-house research team, which counts 10 dedicated individuals specializing in portfolio construction, asset allocation, manager selection, equity and fixed income research, alternative investments, and trading. Each member brings a tremendous amount of value to the organization and to our clients, and I couldn't be more proud to lead such a talented group of people. You may not realize, but 2023 is a very special year for our organization as we enter our 25th year sitting on the same side of the desk as our clients. Now, those 25 years have included bull markets and bear markets. We've experienced geopolitical conflicts, contested elections, asset bubbles, a global financial crisis, a pandemic, and frankly, just about every type of challenge that might arise for investors. But we know that the reason Greenleaf Trust has survived and thrived over this time, and in spite of these circumstances, is thanks in large part to all of you, our clients and our friends. So before I begin recapping one of the more challenging years of these past 25, I want to once again thank you all for your continued support and partnership, and reiterate our commitment to delivering comprehensive investment solutions that help our clients reach their goals. I want to start by recapping the opportunity set that was presented by the markets last year. This slide highlights asset class returns across stocks, bonds, and alternatives in 2022. As you can see, there was virtually nowhere to hide, with positive return opportunities limited to investments in commodities and managed future strategies, otherwise known as trend-following strategies in the alternative space. Equity returns ranged from minus 13% in domestic mid-caps to minus 20% for emerging markets. Meanwhile, fixed income categories, which typically provide diversification in down markets, declined alongside their equity counterparts. If you look to the far right, you can see that even a balanced portfolio constructed with 60% stocks and 40% bonds declined in the double digits last year. And to put that in perspective, it was the worst outcome for a balanced 60 portfolio, the second worst outcome for a balanced 60 portfolio dating back to 1977. It outperformed only 2008, which was, of course, in the throes of the financial crisis. So any way you cut it, it was a pretty challenging year for the investment markets. Now, all that being said, I think a little bit of perspective is in order, because no matter how painful it is or was, 12 months is a very short period of time. So I'd like to point a few things out. First of all, if we look at the year itself, 2022, I bet you if I asked anyone in this audience, you would agree that stocks just fell and fell and fell throughout the course of the year. In fact, that's not the case. All the damage was done in the first half of the year. Believe it or not, in the first half, the S&P 500 declined 20%, and in the second half, it actually gained 2%. Secondly, it might surprise you to know that a dollar invested in the S&P 500 2 years ago is actually worth 5% more today than it was then, and that's in spite of this 2022 experience. Lastly, it might surprise, if not shock you to know, that the S&P 500 index is actually up just shy of 25% over the last 3 years. So in spite of the onset of a pandemic in the first year and a bear market experience in the third year, investors have enjoyed almost an 8% annualized return over the last 36 months. This is actually a pretty good outcome.
All right, so don't let Nick just fool you with the positive spin. We know we've got to cover the bad news of 2022 as well. And to us, it very much felt like a boxing match where the hits just kept on coming. And we're going to share our view tonight that the economy was wobbled but not knocked out in 2022. And we come into 2023 with shaky legs but still on our feet. And one of the cool things about being in business for 25 years is that you get to experience remarkable changes in technology. Tonight, the presentation is enhanced by the use of some artificial intelligence. We're generating these images using a program called DALL-E 2. that helped us get these images of boxers. And the art fans in the audience will note that you can kind of prompt the artificial intelligence to give it to you in the style of a particular painter. Here we've got our Picasso. But with that, let's turn to the punches that were delivered to the economy in 2022. So we came into the year with higher than normal inflation, and that was exacerbated by the Russian invasion of Ukraine, which created some turmoil in global commodity markets. That higher inflation led to tighter monetary policy, so higher interest rates from global central banks, not just in the United States, but across the world. Higher interest rates, in turn, caused a housing slowdown that we're going to cover that really emerged in the second half of the year. And then finally, the combination of all of these factors really caused investors to bring forward their expectations for the start of the next recession. And so anyway, you cut it, a pretty challenging year in 2022.
And one of the messages that we want you to take away from this evening is that investors largely came into 2022 unprepared for these hits. In boxing, if you see a punch coming, you have a chance to get your gloves up, and you're less likely to get stunned or knocked out. It's the punches you don't see coming that tend to do the most damage. And the same is true with the investment markets. Last year, most if not all of the major developments that shaped the year came as surprises. That said, a lot has changed, and we'll argue tonight that investors have tightened their defenses and are now less vulnerable to more negative surprises in the year ahead. Also, it's not like we came into 2022 without any defenses at all. In fact, we weathered all of these punches and avoided a recession last year, thanks to areas of strength in consumer balance sheets, corporate earnings, and a healthy labor market. But with that, let's take a closer look at inflation.
All right, so the art fans will know that this one is our Banksy, and we've got a boxer practicing a jab here. So why do we pick the jab to describe inflation? In boxing, the jab is a punch that's used to keep opponents on the defense and keep them from getting comfortable, and that's sure how it felt to us throughout the course of the year, as it was really difficult to make long-term investment decisions when we weren't sure about the future path of prices and monetary policy. What we're going to try to do tonight is lay out what was priced into markets coming into the year so that you can see what the setup was in terms of where surprises occurred throughout the year. We'll talk about the evolution of markets and the economy throughout the course of the year and the impact in particular to the investment markets. And then we'll try to lay out what the facts are on the ground now as we look forward to 2023 and beyond, and share with you where we think some surprises might emerge in the year ahead. So as it relates to inflation, you kind of have to look back 2 years to the pandemic period to understand why this is such a big surprise in 2022. If you go back to the end of 2020, economists were expecting that inflation would run at a very low rate that it had in the previous years. What was expected in 2021 was 1.6% inflation. And of course, what we actually got was 6.8% inflation, so much higher. This year, economists were expecting inflation would decelerate from 6.8% down to 4.4%, but it looks like we're going to come in at around 6.7% for the year. And we got a variety of explanations from policymakers and economists as to why prices were staying higher, or trending higher. So at first, it was because we were comparing to low prices that occurred during the pandemic shutdown period. Of course, that created artificially low prices, and so they call those base effects. So we were just comparing to a bad rate. Secondly, it was explained by particular product categories. So in particular, those that were challenged by global supply chains being disrupted, like used autos. We know that used autos went up an awful lot in 2021. And it was thought that all of these factors were going to be transitory and worked out of the system in 2022. And of course, that did not happen, and it created particular challenges for consumers in 2022, as even really strong wage gains in the 6% range were not keeping up with inflation. So investors sort of had their gloves up. We were expecting higher than normal inflation, 4.4%. Nevertheless, inflation surprised even higher. And what was the catalyst for that negative surprise throughout the course of the year? It was something that was really tough to see coming. In our view, it was the Russian invasion of Ukraine that sparked a lot of turmoil in global commodity markets.
And that turmoil had implications for broader financial markets as well. For energy producers, it meant that a main source of your competition to supply global demand was taken offline. Global governments responded to the invasion of Ukraine by seeking to isolate Russia economically with bans and price caps on Russian oil. And this led to a banner year for U.S. energy producers, with the S&P 1500 Energy Index up about 64% last year. In the chart on the top right, we highlight the idea that investors actually came into 2022 with expectations for oil price declines. The futures curve, starting at the beginning of last year, highlighted in red, was actually indicating average oil prices of around $72 a barrel last year. The actual average price, came in at north of $95 a barrel, or about 30% higher than expected. and at one point even touching $124 shortly after the invasion occurred. At one point, we even had prominent Wall Street banks declaring that oil was on its way to $200 a barrel. Thankfully, that scenario didn't materialize. Now, meanwhile, sectors that depend on consumer spending or advertising to consumers underperformed, as evidenced by communication services, which was down 40% last year, consumer discretionary, which was down 36%, and information technology, which was down 28% last year.
There were significant implications for the bond markets as well as the stock markets. If you look at the chart on the left, you can see that inflation-linked bonds, Treasury inflation-protected securities, have been outperforming their nominal counterparts looking back to 2020, and in the 1 to 10-year maturity range by about 7%, so pretty sizable outperformance. And in credit markets, it's ordinarily a pretty risky proposition to be lending to energy credits heading into an economic slowdown. They're typically very cyclical with high debt loads. But if you were a high-yield investor and you were invested in the energy sector last year, you enjoyed high starting spreads and really low spread volatility and outperformed perceived safer parts of portfolios such as consumer staples and information technology. So 2022 was really a year to contemplate where really are the safe spots to invest in the global markets. Now, looking ahead, what we're going to try to do is set you up to understand what the markets are pricing in today and give you our view of where we think some surprises could emerge. If you look at market pricing for inflation expectations for next year, whether you're looking at inflation break-evens or inflation swaps, market participants are again expecting a very strong deceleration in inflation. TIPS are pricing in about a 2% rate by the end of 2023 and a 2.5% rate or so on inflation swaps. And so if that sounds very low to you after 2 years of really high inflation surprises, let me go through some of the dynamics that have emerged over the course of 2023 that may reverse the inflationary trends that we've seen over the past 2 years. The first one relates to housing, which we're going to cover more in detail later in the presentation. But when we were up here 12 months ago, we were pointing to rent increases that we could observe at that point that suggested that shelter inflation would run above 6% in 2023. The way they calculate inflation is with a lag on housing and rent prices, and so you can kind of observe what's happening today to forecast what may happen in the future. And indeed, if you look at the chart on the upper right, shelter inflation has been over 7% over the last year, and that's really significant because that makes up about a third of what people spend their money on, so that drives inflation quite a bit higher. But if you look at the slowdown that's been occurring in house prices and you track that forward to the end of 2023, we expect that shelter inflation is going to decelerate from 7% down to 3 to 3.5% by the end of next year. In addition, global commodities have come off of their highs. So whether you're looking at energy commodities, which have fallen since the invasion of Ukraine by about 35% off of their highs, or ex-energy commodities, everything else, are down about 15%. Remember that inflation represents continually rising prices, not just high prices. So we're starting to see some evidence in commodities that prices are falling, not rising. Finally, used vehicles are down about 16% off of their highs. That was a big driver of inflation early. And then finally, one thing that people seem to believe drives inflation is growth in the money supply. And we've seen really significant growth in the money supply in the post-pandemic period until we got to 2022. In 2022, we're actually ending the year with less money supply than we started the year, and it's the lowest growth that we've seen going all the way back to 1960. So if you think growth in the money supply leads to higher inflation, that has turned deflationary as well.
So Chris just mentioned a number of disinflationary or even outright deflationary dynamics that are rippling through the economy right now. However, we continue to recommend a small overweight to TIPS in our client portfolios, which reflects our view that while we do expect inflation to decelerate in 2023 compared to the rates we saw in 2022, we also think that there may be room for upside surprises to the level of inflation that the market's pricing in today. So where could higher than expected inflation originate? Well, for starters, in the labor market. Recall, this is one of the areas of strength in 22 that we pointed to, but it also can create challenges as the demand for labor is significantly outpacing the supply of available workers today. As it stands, there's approximately 10 million open positions in the United States compared to just 6 million Americans counted among the unemployed. And from our perspective, if left unchecked, these dynamics have the potential to continue placing upward pressure on wages in 2023. Another area would be the reopening of China and their departure from zero COVID policies. This could happen in a couple of forms, in the form of increased demand for goods and services, which has the potential to increase China's oil needs to the tune of around 1 million barrels a day. Or secondly, if the reopening causes a surge in new cases, which creates an incremental impact on the supply chain. From our perspective, either of these things has the ability to create a reversal in the decline in commodity prices that we've seen since the first quarter of last year. And to us, a commodity price shock to the upside in 2023 would feel like a repeat of what we're characterizing as 2022's uppercut, which was the Russian invasion of Ukraine. Here we have an artist in the style of Monet throwing an uppercut. Why the uppercut? Well, it's a punch that's very difficult to see coming. It starts down below the boxer's eye line, and it has the potential to do a lot of damage. Many boxing matches have ended with an uppercut. And we believe that had the U.S. not entered 2022 on such strong economic footing and with so much momentum, the Russian invasion of Ukraine could well have been the catalyst for a recession last year. Markets were clearly not anticipating that Russia would invade Ukraine. If you're sitting in the audience right now and you're thinking to yourself, well, it was pretty obvious to me that they were going to invade, and further, it was pretty obvious that that invasion would exacerbate an inflationary challenge that we already have, respectfully, I'm going to push back on that assumption. And I'm going to remind you that hindsight can be 20/20. But just think about all the things that you would have had to accurately predict and forecast in order to effectively trade around this particular event. You would have, one, had to forecast out of consensus that Russia would undertake the first armed invasion of a sovereign European nation since World War II. Secondly, once the invasion occurred, you would have had to ignore the growing consensus expectation, the emerging consensus expectation that it would be short-lived, that Ukraine would be unable to defend itself, and that Russia would be satisfied reclaiming a limited amount of territory in the east. If you recall, there were intelligence reports out there suggesting that this conflict would be over in May with a negotiated ceasefire. Lastly, if you got all that correct, you also had to anticipate or foresee US and European sanction responses and the global divestment of Russian assets that led that country's GDP to crater last year. The point is, these types of events and their derivative implications for the financial markets are complex, far from binary, and exceedingly difficult to forecast.
And now that we have the benefit of hindsight, we can look at what the market impact was of the Russian invasion of Ukraine in 2022. And it sparked sort of a vicious cycle. So the first thing to understand is that Russia and Ukraine represent significant exporters of global commodities, especially energy and agricultural commodities. So there was a price shock in the commodities that were produced in those nations. That price shock led to higher inflation across the globe. In the United States, we had high single-digit inflation, but in Europe, where countries are more dependent, especially on energy commodities from Russia and Ukraine, they saw double-digit, over 10% inflation in 2022. Higher inflation, alongside strong labor markets, led to global central banks raising interest rates, and the combination of these interest rate differentials, as well as fiscal stimulus that was enacted in many European countries just to help people keep the lights on. If you look at the chart on the upper right, natural gas prices rose 17 times their averages in European nations. So imagine paying 17 times your heating bill, and you can appreciate the shock that was delivered to those economies. All of that wound up resetting foreign currency valuations and all cutting in favor of a stronger US dollar versus these international counterparts. The combination of all these factors led economists to downgrade their estimates for 2023 GDP growth. So coming as a surprise, we're not expected to see the 2.5% GDP growth that was forecasted at the beginning of the year. Instead, now economists see negative growth for European nations, the UK and the Eurozone, and just barely positive for the United States. That currency valuation adjustment has a significant impact to US dollar investors in international markets. In the chart on the upper left, we show returns in local currency terms and with a US dollar currency valuation adjustment applied. So if you add it all up across developed markets, if you were a local currency investor, you would have had about a negative 6% return in 2022, and that would have been a welcome respite from the 18% that the US markets were down. However, applying the currency as the dollar appreciated, you were down around 14%. So still better outcomes, but definitely eroding that excess return performance. And again, our philosophy of do investors have their gloves up or not, In European, and we think for emerging markets as well, looking into 2023, that they kind of do. And you can see that evidenced in expectations for earnings growth. So right now, forecasters are predicting near zero earnings growth, so not a lot of optimism in these markets. And you can also see it reflected in valuation ratios, whether you're looking at PE ratios or dividend yields. Investing internationally looks significantly cheaper than it does here domestically.
And so if inflation was the jab and the Russian invasion was the uppercut, then we view the Federal Reserve's response as a string of body blows. Here we have an image in the style of Andy Warhol. We think of tighter monetary policy moves as a string of body blows because in boxing, it's rare that a fight ends with a blow to the stomach. But body blows, they wear the opponent down, they limit their ability to fight back, and they leave them much more vulnerable to being knocked out.
And so from our perspective, the tighter monetary policy, higher interest rates that we saw in 2022 delivered the most damage to financial markets unquestionably. And to tell the story, you kind of have to look back again a couple of years in reverse. What we have here on this chart is what the Federal Reserve has been projecting they would do at different times with their policy rates. So if you go back to December of 2020, we were still in the throes of COVID, and the Federal Reserve was telling us that we wouldn't see any interest rate increases until at least 2023 and beyond. If you look back just 12 months ago, the Federal Reserve was actually more concerned about having to go into lockdown again because the Omicron variant had just been named a variant of concern by the World Health Organization. And they were saying, despite this 6.8% inflation we just saw, we might be able to get 75 basis points of interest rate increases delivered in 2022. And instead, what actually occurred this year was not 75 basis points total, but multiple meetings with 75 basis point rate increases consecutively. And that's exceedingly rare. This has been the fastest interest rate hiking cycle going back more than 40 years. And at this point, we're at a 4.5% Federal Reserve rate, and with projections to go over 5% in the year to come. So the impact to markets is pretty direct and significant when you start changing policy rates. In the bond market in particular, today looks like a much more attractive time to get invested than 12 months ago did. So investment grade bond categories are now yielding 3 to 5.5%. And if you look back a year ago, that was in some cases less than 1, but 1 to 2%. And so today's entry point looks much better than what we had last year. However, it came with a lot of pain as we transitioned to these higher interest rates. If you were an investor in longer duration bonds like 30-year treasuries, you didn't experience the 25% drawdown that global stocks experienced. Instead, you saw a drawdown of about 50% of your capital. And that level of interest rate shock doesn't just stay contained to the bond markets. It was interesting to us throughout the course of the year that higher interest rate volatility, which by the way creates some opportunities for bond market investors in callable bonds, it coincided with really poor stock market performance. In the chart on the bottom right, you can see as interest rate volatility rose throughout the year, stocks fell and fell and fell.
As Chris said, higher interest rates don't just impact the bond markets, as equity valuations depend to a great extent on the rates that can be earned by safer assets like bonds and cash. So higher interest rates mean higher returns are being offered by bonds and cash, and therefore equity valuations tend to fall in order to overcome that higher hurdle rate. We illustrate this relationship in the chart in the upper right. So as the year progressed and as interest rates moved higher, moving from left to right on the chart, you can see that equity valuations actually declined from a starting point of just shy of 22 times at the beginning of the year to less than 17 times at the end of the year. That's valuation compression of more than 20% over the course of 12 months. At the same time, remember we mentioned earlier that corporate earnings, one of the areas of strength last year, actually held in pretty firmly. Throughout the course of the year, earnings expectations came in a little bit. However, we're still entering 2023 in positive territory. And so if you look at the chart in the bottom right, we've highlighted the actual path of the S&P 500 last year in red, and then we're highlighting constant valuation returns for the S&P 500 in blue. And so the idea here is that if we hadn't experienced these hawkish surprises, these body blows from the Fed, perhaps we could have navigated the year with that consistent earnings multiple that we had at the beginning of the year. If that's the case, then you would value equities solely based on your earnings expectations. And under this scenario, stocks would have delivered modestly positive returns last year. And these body blows, these hawkish surprises from the Fed, they also create particular challenges for asset allocation. So typically, in periods of low and more stable levels of inflation, stocks and bonds tend to be negatively correlated. This is a particularly useful characteristic for asset allocation because it means bonds provide excellent diversification benefits against stocks. In the events that stocks fall, bonds not only hold their value, but they actually tend to appreciate. However, during periods of high and more volatile inflation, the relationship tends to flip, and stocks and bonds begin moving together. Now, that's not to say that the diversification benefits of bonds are eliminated altogether, but they're certainly greatly diminished. And this was the case in 2022, as we saw stock and bond correlations rise sharply throughout the course of the year. In the table on the bottom, we're highlighting rolling 6-month returns for every week going back to 1976. And what you might notice is that most of the dots on this chart show up in the top right quadrant of the image. And that's depicting periods of time where both stocks and bonds rose together. You might also notice that there are very few dots plotted in the bottom left quadrant of the chart, which would denote periods of time when stocks and bonds fell together. So it's a very uncommon phenomenon to have stocks and bonds both falling at the same time, but it was the norm in 2022, as you can see highlighted in red. This is one of the things that we took into consideration in late 2021 when we recommended our clients increase their exposure to alternatives, strategies like managed futures, at the expense of fixed income. We were concerned that the potential for higher than expected inflation and low interest rates could diminish or impair bonds' traditional role in portfolios. Now, the question going forward that we should be asking ourselves heading into 2023 is whether or not the Fed will respond to economic weakness by cutting policy rates, which would have the effect of driving bond returns higher in the event the U.S. was heading into a recession. Also, keep in mind, it's not like correlations will just flip back to negative overnight. So as painful as it was to experience a year like 2022, when equities and bonds both fell together, it might be equally as painful to go to the sidelines and miss out on a period where stocks and bonds move higher together, which could well be the case if equity markets reward future Fed rate cuts.
That's right, and on the topic of the prospect for Fed rate cuts, how are the bond markets positioned heading into 2023, and where do we think the surprises might fall? The chart on the left looks out over the next 12 to 14 months and shows that the bond markets are currently pricing in an expectation that we will see more interest rate increases next year, about 75 basis points, so not nearly as many as we had in 2022. And coincidentally, that's exactly what the Federal Reserve told us at their last meeting they were intending to do in 2023. However, where they start to diverge is that the bond market is then pricing in the expectation that the Fed will cut policy rates, which is a response that it does when we run into some kind of economic trouble or economic weakness. So we think pretty clearly investors are expecting something to emerge that causes the Fed to respond in 2023. So you might be able to look at that and say, okay, the bond market's behind the Fed, maybe we're poised for further interest rate shocks. If we get them, they're going to be marginal, nothing like what we saw in 2022. However, if you look out a little bit further to the chart on the right, in red and blue, we're showing expected cash rates over the next 3 years. And what you can see is that bond market investors are currently expecting the Fed to keep the rate above 3.5% over that whole time. Well, the line in green shows the average Fed response to the last 4 recessions. So ordinarily, when we run into trouble, the Fed responds by accommodating with monetary policy by cutting the rate. And on average, over the last 4 recessions, that's been worth about 3.5% to 4% rate cuts. So the question is, do bond market investors have their gloves up for tighter Federal Reserve policy? If you look out over the next 3 years, we would argue that yes, they do, clearly anticipating that the Fed is only going to respond with 1.5% rate cuts when they ordinarily might do 3.5% to 4%. And keep in mind, 2024 is heading into a presidential election. This whole process is political, and we think the Fed would love to have their policy moves done by the time we head into that election cycle.
So here we have an image of a boxer throwing a cross in the style of Mona Lisa. Yeah, I know. the eyes, right? I've seen the Mona Lisa up front, and she doesn't look like that. Our best guess is that the artificial intelligence applied the idea of a cross to the boxer's eyes as well as his arms. At any rate, we view the deteriorating housing market dynamics as the cross because it came following that string of body blows delivered by the Fed in the form of hawkish surprises.
Yeah, and so looking into the housing market, what was expected in 2022 was another really strong year like we had just experienced in 2021. Mortgage rates coming into the year were 3%, if only now, and over the course of the year, the Fed kept ratcheting up interest rates, and the mortgage rate followed alongside, eventually hitting about a 7% rate in the second half of the year. So what did that do to housing affordability? Well, at the beginning of 2022, you could purchase the median home and make a principal and interest payment of about $1,300 a month. But at one point, that got up above $2,000, more than 50% increase in the cost of housing over the course of the year. So market participants were expecting another banner year, and what happened was over the course of that time, we got tighter and tighter financing rates. Housing market activity deteriorated really significantly. So coming into the year, median forecasts for new home sales fell about 25% over the course of the year, and forecasts for existing home sales fell about 15%. And in fact, this level of housing market decline, slowdown, actually printed the most negative contribution to GDP growth in the third quarter of 2022 that we've seen other than just the fourth quarter of 2007 when we were in the throes of the financial crisis. So a really significant housing market slowdown, but that's what the Fed is trying to engineer with these higher interest rates. And you can see it did flow through to housing prices in the chart on the bottom right. You can see the very unusual post-COVID period when home prices were appreciating more than 1 or 2% per month. That implies 15 to 25% appreciation over the course of a year. Way too fast for the Fed's 2% inflation target. But finally, as the Fed got over that 6% hurdle, house prices started to slow in the second half of the year. And the impact of the markets of these surprises were pretty direct. Any kind of housing-related stocks, whether you're talking about home builders, home furnishers, or home improvement, underperformed the broad market. But what we didn't see yet was layoffs affecting the real estate market or industry. So the real estate industry is one that has tentacles into a lot of other parts of the economy. You think about the appliance makers or the financing companies involved in purchasing a new home. There's probably about 9 jobs that are related to employment in the real estate industry. We haven't seen much in terms of employment deterioration, but that's what we've got our eye out for in 2023, especially if we continue to see slowdowns like we saw in 2022. The other place that we saw this really impact the economy in 2022 was via consumers. So they were dealing with higher prices at the pump, higher prices at the grocery stores, and then, yes, higher prices for housing as well. And they started to use up the savings that they had accumulated over the course of the pandemic when everybody was getting checks in the mail. We think those excess savings, more than the normal rate of savings, added up to about $2.5 trillion in total. And in 2023, we've used up about $1 trillion of that. And we use it up at a pretty crisp pace. So this was one of the other places of strength that helped us avoid a recession this year. That defense is still in place heading into 2023, but suffice to say it's a lot worse. And we probably have a year to 15 months worth of excess savings left here. And so you started to finally see in the second half of the year some of the really hot housing markets that occurred post-COVID start to slow down. We've highlighted some of those in the chart on the left. I'll just use Austin, Texas as an example. I visited Austin, it's a great city. I thought about moving there after COVID hit like everyone else. And it's reflected in the prices. They appreciated 75% in the 18 months after COVID before finally starting to decline. And the way we're kind of thinking about it is that the Federal Reserve is trying to hit an interest rate that is sufficiently restrictive to slow down these price increases. It's hard to know in advance when you're going to get there. And it seems like we've got market evidence now showing that they're just about there. That's why we don't think the Federal Reserve policy rate can go to 8-9%. We think we're right in the range where we're starting to slow things down. And you can see that actually as well in people's forecasts for the housing market next year. The chart on the upper right, first of all, you should know it's pretty rare to see broad home price declines in the United States. Looking all the way back to the 50s, it's really only ever happened after the financial crisis. But next year, economists, everybody except for, I don't know if we have any realtors in the audience, but the realtors still think the price is going to go up. But everybody except for the realtors are predicting price declines. And they must be analyzing the supply-demand dynamic for 2023. In addition to demand being dampened by these higher rates, we've also got record number of housing units that are under construction right now, waiting to be delivered in 2023. And multifamily is really high. It's only ever been exceeded for a brief period of time in the 1970s. So we think any future price dynamics probably aren't going to be inflationary like we've seen post-COVID. They may actually start to cut in favor of buyers in 2023.
And now, for our last punch of 2022, the timing of the next recession, we have a Michelangelo-style portrait of a boxer throwing a hook. The hook is one of the most powerful punches in boxing, and many boxing matches have ended with a hook. And we use this to denote the timing of the next recession because we know recessions can also have a very powerful impact on the economy and the markets.
Yeah, so the R word was not on anyone's lips coming into the year. Economists were only forecasting about a 15% chance that we might have a recession in 2022 and about the same for 2023. Of course, we've gone through all of these negative surprises that have hit the economy this year, and forecasters have ratcheted up that expectation. You should know that the average expansion lasts about 5.5 years, at least in the post-World War II economy. And coming into 2021, we were just 1.5 years or so into this current expansion. And as we sit here today, 2.5 years. So it would be quite early to have a recession in 2023. However, we know that this recovery has occurred much more rapidly than people were expecting. And so perhaps we'll have a shorter business cycle than what was anticipated last year.
That's right. And entering 2023, economists are predicting a 65% probability that we'll enter a recession at some point in the next 12 months. It's not super difficult to see why, as many of the indicators that we monitor are suggesting an elevated likelihood of a recession as well. We look for things like a trough in the unemployment rate, as rising unemployment can be an indication that a recession is near. We enter 2023 with actually full employment and very strong labor dynamics, but we have to wonder if or when tighter policy moves from the Fed dampen the demand for workers. Secondly, we look for things like a real decline in retail sales levels, as consumer spending makes up the vast majority of US GDP. This indicator triggered back in March and has remained in concerning territory as elevated inflation levels have eroded consumer spending power throughout the year. Lastly, we're always on the lookout for an inverted yield curve. This historically has proven to be a very reliable indicator that a recession is on the horizon. The yield curve actually steepened through much of 2021, but then flattened in 2022 before inverting as Fed policy moves push shorter-term rates higher and higher. Now, usually, recessions come as surprises. But today, it seems like just about everybody's in agreement that we're poised to have one in 2023. So we have to wonder, how damaging could a recession be if it's well anticipated? In particular, in light of the fact that global equities are currently trading at a 20% discount, and the Fed is able, if not willing, to offer some relief by loosening policy from current levels. Historically, even when recessions have caught investors off guard, the investment outcomes probably haven't been as bad as you might expect. We studied the 15 recessions that have occurred in the United States over the last 100 years, and we determined that disciplined investors actually enjoyed returns of 8.5% on an annualized basis, beginning 12 months prior to each recession and ending 12 months after the recession. Now, further, what we're saying is if you were invested in the market 12 months prior to the recession through 12 months later, then you would have experienced 8.5% annualized returns over that 3-year window of time. Further, the typical playbook of underweighting stocks, overweighting long-duration bonds, and trying to avoid commodities might not work this cycle, given some of the unique dynamics that are at play. So from our perspective, the way to generate returns is not to try to time recessions and not to make major departures from your strategic asset allocation, but rather to stay disciplined and maintain your focus on the longer term. And in the longer term, the forward return outlook is actually greatly improved from where it was 12 months ago. We'll illustrate this point first with domestic equities. So with equities, when you think about future returns, one of the key determinants is your starting valuation. So higher starting valuations indicate lower expected returns, whereas lower starting valuations indicate higher forward expected returns. If you remember earlier in the presentation, I described how domestic equity valuations compressed by more than 20% over the course of 2022. That means that we're entering 2023 with much lower starting valuations than we had a year ago. And that means that our forward expectations for growth in equities is actually much improved. In fact, our analysis suggests that over the course of the next 10 years, investors might expect approximately 7% annualized return from their domestic stocks. And that expectation has improved from less than 5% a year ago and closer to 4% entering 2020. So in spite of elevated levels of short-term risks, the prospective return opportunity has actually now improved to more normal levels and more compelling levels. The same is true for bonds.
That's right. And this part of the presentation is the good news I promised at the beginning. So it was pretty difficult to come up here the past few years and promise you that over the next 10 years, your core bond portfolio would get you 1% a year. That was 2 years ago. Last year, that had improved to 2.2%. Well, this year, finally, yields have improved to a point that we think it's actually a pretty attractive entry point into the bond market. Over the next 10 years, easy to see 4.25% returns annualized going forward. And that's about the best entry point that we've seen in almost the last 20 years. If you track that blue line back to 2002, there's been barely any times that looked better than today to get invested in bonds.
And so we do similar analysis across a wide range of asset classes, and we update our assumptions every 6 months. We present our current capital market assumptions on the page here, and what I would tell you is that across the board, our expectations in all major asset classes have improved from where they were a year ago. Here we show you the evolution of our capital market assumptions, our long-term forward return expectations over the last 4 years. And again, you can see that upward trend with a big pop-up here at the end of 2022 heading into 2023. Tying it all together, if you look to the far right, we think, and our analysis would suggest, that a balanced portfolio constructed with 60% stocks and 40% bonds has the potential to return on average more than 6% over the course of the next 10 years. And that's up from just 4% expectations a year ago and 3% expectations entering 2020. And of course, we're active managers, so we're going to try to do a little better than that, but we think that's what the benchmark has the potential to do over the next 10 years.
Of course, we know there are risks, and much of this presentation is about the risk that surprised and really made 2022 a difficult year. So we want to highlight some of the risks that we're monitoring heading into 2023. We've categorized them into 4 categories: market, inflation, business cycle, and geopolitical. And we've tried to map them in terms of how severe we think the impact would be if these risks emerge, and then also how probable they might be. So we covered house prices, and it certainly seems that there may be a probability that house prices fall, but we would extend that thought also to areas of the commercial real estate market where it appears to us valuations haven't fully adjusted to reflect these higher interest rates and potentially higher financing risk going forward. On the inflation side of things, of course, it would be foolish to think after 2 big years of high inflation surprises that it couldn't happen again. So we list that as a risk, and that could induce tighter monetary policy again in 2023 than people are expecting, which would feel like a mini repeat of some of the issues we had to grapple with in 2022.
There are also tail risks to consider in 2023. These are risks that we think are remote, would catch investors off guard, and would have a substantial impact if they were to actually occur. 2 that come to mind for us are a potential Chinese invasion of Taiwan and the possibility of a U.S. default should policymakers fail to raise the debt ceiling later this year. So all that being said, we enter 2023 feeling cautiously pessimistic. There are many unresolved issues that will impact the economy and the markets in potentially unforeseen ways in the year ahead. At the same time, and unlike entering 2022, we believe investors now have their gloves up and are better prepared for the punches that the new year could throw our way. Further, in spite of a myriad of short-term risks identified by us and raised by many of you, history and our capital market assumptions would support a forward long-term return outlook that's more compelling than we've had in many, many years. So if you're a retiree sitting on a nest egg, this is not the time to move to the sidelines. If you're a saver who's putting money away every quarter, every month, every paycheck, these aren't the payments that you want to miss. Lastly, discipline is key. And to us, that means remaining committed to the financial plan that you developed with your advisor, avoiding major asset allocation shifts that are out of alignment with your long-term investment objectives, and resisting the urge to time the market, even when it feels like the punches just keep on coming. Remember, we're in your corner, working behind the scenes, implementing tactical portfolio adjustments, rebalancing to reduce risk, and harvesting taxable losses when it makes sense to do so, all in the interest of optimizing our clients' portfolio outcomes. Our disciplined approach to financial planning and investment management has served our clients well over these last 25 years. And we have no doubt that it will continue to serve them well in 2023 and the years beyond. Thank you again for joining us this evening, and all the best in 2023.